Master your money, free your future. Welcome to Budget for Life. My name is Jeremy. I'm a financial advisor, but this video is not financial advice. This is for your education and maybe a little bit of entertainment. We're going to dive into the convertible bonds, not just what are they and how do they work, but also what are the potential outcomes based on what GameStop's stock price does and how soon. Are they going to be redeemed early? What would happen to the different potential buyers in that case? We're going to try to get super granular about it. And why do I get so granular? You might be over here like, come on, Jeremy, why are you getting in the weeds of the fundamentals? And I'll tell you why, okay? Because my business is my business. All right. If I am a stockholder, right? If I'm a business owner, if this is at least partially my business, then anything going on with that business is my business. I want to know what's going on inside and out. My business, my business. All right, before I get into it, hey, thank you so much to the viewers. Over 20,000 views. Guys, you are crushing it out here, beating the game for sure. Thank you to the viewers. Thank you to the subscribers, putting in some work, okay? 1,421 subs. And thank you to the fans of the channel who get some discounted merch and fun ways to interact, a little bit of clout. And thank you to those who join as friends of the channel who basically take this channel to the next level, support me personally, support the research, and get access to my GameStop spreadsheet. Just so you know, I have yet to make a dollar. Okay, but every dollar that I make, I am committing to DRS booked GME shares. So it's just going to the greater infinity pool, and I'm happy to turn that into giveaways and ways to kind of kick back and thank you guys as the viewers as well. This is not a big plan for me to try to make a bunch of money professionally. Again, I manage money for clients, and that is my source of income. But I thought, hey, to honor you guys, any amount that you say thanks for this research, I'm happy to contribute those proceeds to the cause of GME. Okay, so convertible bonds, let's dive into it. Let's get big picture and then we'll get small picture. Why did GameStop offer convertible bonds, which we know, okay, during uh, Q1, they raised, 1.5 billion via convertible bonds, and during Q2, they raised what was it, 2.7 billion via convertible bonds. So they raised 4.2 billion dollars through convertible bonds before they just sold shares at the money. They just did equity raises the old-fashioned way. So, and also since then, we know that they are aiming to raise another 1.9 billion through these stock warrants that they're giving as dividends on a 10-to-1 basis. But we have 4.2 bill of convertible bonds. So why did they offer them? To raise money. Duh. Okay. GameStop, why would they even want to raise money? So that they can make money with that money via interest and gains, so that they can invest that money into their retail business, which they are scaling, and so they can accelerate their transition into being a holding company via company acquisitions. I want to show you guys, sorry, I should have had this already pulled up, but on their most recent 10Q, and I want to go back and see when exactly um, they started adding this to their language. How many times do they use the word business in here? Okay, it might take a while to get there. Where is the page that I'm looking for? There's risk factors, balance sheet. Okay, we're close to it. Their retail business. Before that, their business priorities. Okay, they are telling you what their priorities are as a business. This matters so much to you as shareholders because I could show you in earlier 10Ks, earlier reports, their priorities were to cut costs to become profitable as a company. And that is still their second priority, right? Optimize the retail business to achieve profitability and increase profitability within the retail business. But they have told you what their first priority is. Their first priority, number one priority as a business, using our cash and other sources of liquidity to maximize shareholder value, including through potential investment and or acquisition opportunities. Another way that they said this was Ryan Cohen in one of his CNBC interviews this past quarter. He said in a nonchalant, obvious way that, hey, the long-term value of GameStop is going to be predominantly driven by how we utilize cash, what we do to grow and expand, what businesses we buy. In other words, the long-term valuation is going to be far more driven by GameStop, the asset manager, and secondarily by GameStop, the retailer. What's so exciting about GameStop shares right now is that even if you didn't value them as an asset manager, you place no premium on that, you just let them use cash, and that's the way that you value them. They are still really uh, like interestingly priced, really low price. There's still meaningful upside in their shares purely on their retail performance trajectory. But the retail can only scale so far. There, you can only sell so many things in a store. Like, okay, we have the Switch 2, Pokemon cards are blowing up, right? The Pokemon Legos coming out next year. They just started selling Legos. Like, they're gonna find more things to sell that are closer to what people want to buy. But all you can do as a retailer is sell stuff. Like it's not necessarily like infinitely scalable. Of course, it could scale much further than where it is right now, and they're doing so. But why would they raise convertibles? Because their top priority is to grow their asset management business. And how do you grow? How do you scale an asset management business? It's by getting assets, right? Whether it's the cash we already have or whether it's cash someone else is going to give us, we are trying to beat the spread, right? If I can use this money and do better with it than the 0% interest that it's causing me, then everything I make in the middle is mine to keep, right? So they've already told you their focus is to improve as a holding company, to improve as an asset manager, and they are going to continue keeping that focus until they tell you that they're not. But so far, I don't see any reason why they would slow down generally in raising money, as long as they feel that they can do more with the money than what the money costs them. So that's why they're raising money. It's not for their retailer, it's for their asset management business. The more assets they can manage, the greater the impact of their asset management outperformance, right? If if you're talking about on a valuation basis, if they only had $1 billion in cash, well, they could quadruple that cash. And what did that do for them? It turned 1 billion into 4 billion. That makes them $3 billion more in market cap, which basically equates to about $6 a share of outperformance. But they could make the same investment with $9 billion. And if they quadruple from 9 to 36, well, they just grew their market cap by $27 billion, which is about $54 a share of stock price improvement in the underlying. And that's just based on the raw dollars if you continue to value them at cash. But if they outperform with critical mass and money, then that's also going to affect the multiples they're getting, whether on a price to book, price to earnings, price to sales. They are going to start achieving a valuation within their asset management business that's a multiple that's lucrative, particularly when they can do so at scale. More people can turn 1 billion into 4 billion than people that can turn 9 billion into 36. So again, the more money they have, the greater the impact of their outperformance with that money. So why wouldn't they just use the money that they already generate, right? They cleared $300 million of cash from operations just in Q2 alone, right? And then you have all the interest and gains as well, which is another $100 million that they cleared. Because investors have already been waiting 84 years. Okay, just kidding. But if they did that, it would take longer. They want to scale faster. So leveraging money is how you scale faster. The trade-off of leveraging money is that you increase risk. And we're going to dive into what the risks are of these convertible bonds. Why wouldn't they offer normal bonds? Because normal bonds cost more, basically. So it's a more expensive form of debt to offer normal bonds, at least in the short run, because the coupon payment is going to be higher than zero on a normal bond. The reason that they can offer a 0% coupon on the convertibles is because those bond buyers are assuming their upside is going to come from the conversion price difference, that their upside is going to come from the equity performance, not from just the interest rate. If you take out that equity conversion dynamic, then of course you would have to offer some type of return on investment in the form of interest. So they don't want to have interest payments right now. They would rather keep their interest payments low and clear as much cash, as much profit as possible. Why wouldn't they do an at the money offer? Why wouldn't they just sell new shares like they already did? I mean, I'm not saying that they won't do that again, but when you sell shares, it guarantees an immediate dilution of shares. And as an investor, that has been frustrating, right? And people normally don't like it. It also potentially enables short sellers, right, who could use those shares to continue to sell short. Convertible bonds do not guarantee dilution. Dilution is still in GameStop's choice. First of all, it's conditional on the stock price appreciating. So even as a shareholder, if you get diluted, it's only after you've seen upside. But secondly, even if the stock does appreciate, it's still GameStop's choice whether or not to dilute or to pay back the convertible bond in the according cash value. And then lastly, even if they do dilute, the dilution happens at the end or unless it's converted early, but the dilution happens later than now, right? Selling shares happens, the dilution happens right now. If GameStop dilutes, it happens later from now, so they can benefit from using that money in the meantime without having already caused the dilution. So who buys these bonds? Like why would anyone agree to a 0% interest rate? There's basically two types of buyers, and they're both institutional clients. So one is the bond fund, the other is the derivative fund or the ARB desk, the ARB fund. Neither of these funds are necessarily even allowed to buy equities based on the terms and strategy of their fund. They're also not even necessarily interested in buying equities. So this gives um, a market, an asset to a market that is not in the market for your equity. Thirdly, there could also be short sellers, right? What's the demand underlying for GameStop convertibles? It could be short seller driven. Maybe they're able to use these convertibles as a locate and eventually use the diluted shares to cover a portion of their short sales, which they would rather do via convertible bonds than buying on the open stock market, covering their shorts now, and risk the stock appreciating or even triggering a short squeeze if they do that. So a short seller could, hey, let me own these convertible bonds. And I don't know what happens behind closed doors any more than you do, but it's certainly plausible to me that the SEC and other regulating bodies would say, yeah, you can use the shares that will be created in 5 or 7 years as a locate, or we will let you sell against those shares that don't even exist yet. So speculatively, short sellers could be in demand for these bonds as well. What's in it for the bond buyers? Basically, they get the benefit of the stability of a bond. So there's very little downside risk because they have a senior status as a creditor. And simultaneously, they participate in the company's upside. So generally, if you are someone who thinks that GameStop will go up, but you're a bond fund, you can't just buy the equity, then you could buy this convertible bond, enjoy the growth of the equity, which would exceed the growth rates you could normally get in a bond instrument, while still having really high downside protection. What's in it for the derivative fund? Why would why would they be interested in these convertibles? Basically, they're interested in owning the fact that this convertible bond essentially is a call option. And that means there's a dated strike price that's out of the money, and at least at the time of pricing, it's out of the money. And the specific terms for that call option, when you buy them from GameStop through their convertible bond, you get it at cheaper rates. Basically it's an automatically undervalued call option. And in terms of the total dollar amount that you can secure, you wouldn't be able to secure that from a market maker directly. And when they buy that call option, that comes with an inherent positive gamma, which the funds will try to isolate by hedging out their delta. So basically, they are interested in GameStop's volatility and buying these convertibles in order to essentially appreciate or to leverage that volatility for their profit at a discount compared to if they had bought that through a market maker. Also, market makers usually don't sell call options 5 years, 7 years out, right? So it's just terms you don't have these terms anywhere else. The only way you can get these terms for these call options, these call options, the convertible bonds, is through GameStop, and they can buy dips, sell spikes to continue delta hedging, making money on the volatility in the meantime. Making sense so far? So let's talk about the terms of GameStop's bonds. They have two bonds, and they're both 0% interest. The first 1.5 billion ends in April 2030. The second ends in June 2032. The conversion rate of every dollar they received is 33.497 shares if the shares are worth more than 29.85 in April of 2030. Or if they're worth that or any more than that, then GameStop will owe the 1.5 billion, right? This amount of shares, 1.5 billion dollars, right? Times this amount of shares would get you this many dollars per share. So they just owe the 1.5 back. And if the shares are worth more than that, that's the amount of profit that the convertible bond lenders will have received because they're paid back in share value, not in pure dollar value. So they're not just owed 1.5 billion, they're owed minimum 1.5 billion. Minimum, worst case for the bondholder, they get their money back, right? Best case, these shares by 2030 are worth more than 29.85. If these 33 shares are worth more than 29.85, that is the profit potentially that the lender is going to get. Now, GameStop has the choice to pay back the bonds in cash, but only at what these shares are valued at. So if these are, whatever, if those 33 shares are worth $40 a share, GameStop could choose to pay it back in cash, but they're not paying 1.5 billion in cash. They're paying $40 times 33.497, right? And they can do any combination of that. They could pay some of it in cash, some of it in shares, but generally speaking, it's presumed that they would dilute, but we'll talk about potential scenarios in a second. One important thing I want to talk about here in this video too is the lenders can convert early if GameStop shares hold above 38.81 for 20 of 30 trading days. So if any 20 days within any 30-day window, if that ever happens, then the lenders can convert early. And so I want to talk about if they would do that, what would happen to GameStop if they did that. So the second bond, very similar terms, but 2.7 billion rather than 1.5 billion. So more money means more dilution. It's 2 more years down the road and slightly more shares, one extra share per $1,000 that GameStop got to benefit from. And again, can also be converted early at the lender's discretion. So the lender can decide to convert early, but GameStop still gets to decide if they pay that conversion in shares or in cash. Now, I want to talk about what are the odds that these convert before I talk about these scenarios, because we see this convertible bond strategy kind of maximized through MSTR MicroStrategy. And I just want to highlight that MicroStrategy's stock is is totally just a proxy of Bitcoin. It's totally dependent on Bitcoin. So if you are a buyer of MicroStrategy stock, you are betting on Bitcoin. And if you are a lender to MSTR's convertible bonds, you are betting on the demand for Bitcoin continuing to exist and increase. I say that because one, it's easy to see how they were able to receive so much money in convertible bonds because Bitcoin has such a huge market cap, like it's over $1 trillion market cap, but it's a new enough asset class that so many funds, bond funds, even equity funds, right? So it's not just bond funds, it's also equity funds, it's also ARB funds. So many of them are not allowed to directly own Bitcoin based on their own kind of archaic investing rules. And so there's so much demand for Bitcoin exposure. MSTR gave the financial world an opportunity to have Bitcoin exposure, even if they don't have Bitcoin authorized as a asset that they can invest in. So MSTR got to finance a ton of money, and as a result, buy a ton of Bitcoin. And as a result, they've almost added pressure to bears of Bitcoin, added pressure to the bull thesis because now they own so much Bitcoin that other foreign governments and other companies are like, we can't let MSCR own more than 50% of the world's Bitcoin because then they're going to rule the world, right? So now we have to buy Bitcoin just to keep them from buying all the Bitcoin, right? So they have had a huge catalytic effect on Bitcoin's price. But the downside risk, I would say, is higher with it's harder to project what will Bitcoin's price be 10 years from now. And if Bitcoin's price craters, MSTR will crater. There is no other like corporate value that MSTR brings. Now let me tie this to GameStop because GameStop is saying, hey, we're going to be worth this per share in 5 years. MSTR also does that. But again, can, the only way they will do that is if Bitcoin performs, right? GameStop, which MSTR doesn't directly control the performance of Bitcoin. GameStop is saying we'll be worth this per share 5 years from now, at least, if not more, right? But GameStop has a lot more control over their trajectory because they're talking about the performance, just the performance of them as a retailer. You can project out what are the odds that in 5 years they will be worth, $4 more per share. And it's like, well, let's talk about their performance and say, okay, they're on pace to make $500 million in 2025. And let's say that convertibles keeps growing, right? Hardware is going to have a nice bump. We'll do an actual revenue projections video soon, but I'd say they're going to continue to make at least $500 million more per year, but probably more because we know that SG&A is going to drop again, reflecting the stores that have already closed and already getting through the store closure costs. We know we have another console cycle with PlayStation and Xbox on the way. We know Grand Theft Auto comes out next year. We know that Pokemon's Lego sets come out next year, right? And we know they're just beginning this Power Packs launch, which we haven't even seen yet. So let's say that they grow, they make 500 million in profit this year, and let's say super conservatively, they just increase their profit by 100 million each year since then, each year following then, I think really you could still say very conservatively that they would increase their profit even by 250 million in 2026 compared to 2025. But still, for argument's sake, let's just say things are super slow. The cost cutting is not as big as they thought. Power packs isn't very big. PlayStation and Xbox don't even end up making another console. Like just they still would say, okay, 500 million in profit 2025. What does that mean for the shares? Well, right now um, there are less than 500 million shares available. There's 447.4 million shares in the float. So every $500 million that GameStop clears in net income, I'm talking about clearing, right? Not just revenue, but clear net income. $500 million is what they're on pace for in 2025. That's more than $1 per share of value. And then if they do it again in 2026, well, that's another more than, right? If they make 600 million in 26, and then 700 million in 27, and then 800 million in 28, and then 900 million in 29. What is that? That's another $3 billion, right? Which is another $6, more than $6 per share in just cash that they are going to earn before the first 1.5 billion is due. So and let's say their retail business, like the retail business realistically is going to have higher value than what it's currently being valued at based on what they're projected to do, right? But let's say that, again, worst case scenario, the retailer is still not valued at all. Their PE plummets to a zero point 0.5 PE. Like it's just the most manipulated stock you've ever seen. The cash value is still going to be the cash value. And if their cash value, even if they have another 1.9 billion on the way, okay, it's already coming. But even if the warrants didn't get exercised, which they probably will, you still have another $6 per share, or really seven if you include, and more than that, it's really probably more like $8 per share of net income of just cash value that GameStop's going to generate between now and April 2030. Right now, their cash value per share is what? Their 11.1 billion in market cap. So what is that? About a 20% drop. What is it? About $22 a share in cash. So add that $9 per share that they're going to generate in cash. Again, even if nothing's valued on GameStop, the retailer, even if the growth is super modest, even if they don't raise any new money, they are still going to be above this conversion price. And how much more so for an even lower conversion price, even 2 years further out. So you don't have to be a GameStop permabull to basically write off this debt, right? The total liabilities on the debt of the convertibles is basically negligible. Like there's really no way realistically that GameStop will be worth less than that because all they have to do is nothing to be worth more than that on just a cash basis, just on what they're doing right now. Just, even if they don't grow by the extra 100 million each year, just do what you're already doing and you are on pace to exceed that strike price, that conversion price. And so as a GameStop shareholder, should you be concerned about the debt of the convertibles? Do you have to see GameStop above 29.85 per share right now to know that they will be above 29.85 per share in April of 2030? No, you really don't. You really don't, which is different than MSTR, who lacks the ability to control the valuation multiple that they're given and the direction of Bitcoin. But they've become so huge that they actually are much more of a catalyst for the direction of Bitcoin than probably anyone suspected when they first started these instruments. Okay, let's go into what happens. So if they end up diluting all of these shares at these conversion dates, then 143 million more shares are created, a dilution of 32% of the current float. So what could happen? So I know I just told you how the stock price is going to be above these triggers, but what if it's not? Basically, GameStop pays back 1.5 billion and 2.7 billion flat. No interest. What's the risk to reward in that scenario? Basically, the risk is if what if they can't pay it back, which the risk of that is effectively zero because they are keeping the money in cash, right? It'd be riskier if, let's say, GameStop bought a business for $7 billion dollars during Q3, and then they bought another business for $2 billion dollars in Q4. And even with the cash they generate from their business, now they have two other expensive businesses and they only have 1 billion left in the bank again. Then you could start saying like, "Oh man, are they going to be able to pay back this 1.5 billion?" It would not be, first of all, they won't do that. Second of all, it still wouldn't be risky because they're still generating enough cash to generate another 1.5 billion between now and then. And thirdly, there's still a demand for their convertibles, right? MSTR's demand is related to Bitcoin and many firms not having the authorization to even buy Bitcoin directly. Well, guess what? Some of those firms are going to start having authorization to buy Bitcoin directly, right? So the demand could wane in the future for MSTR's convertibles. For GameStop, volatility is still so high, and you have the bond traders, but probably the biggest underlying support for the demand for convertibles is the short sellers of GameStop. At the very least, there will be shorts until the shorts are gone, which you'll know the shorts are gone if GameStop's at the very least commanding a fair valuation for the businesses that it runs. But as long as the shorts are in the picture, there's demand for GameStop shares, while still a desire to suppress GameStop shares, which the convertibles are a perfect instrument for. All let's say, even if they're unable to pay back the 1.5 billion, then it's like, well, could they raise a new 1.5 billion? Rob Peter to pay Paul. At this point, with this low amount of money, it seems almost certain that yes, they would be able to. All that to say, they have the money on the books. They have the money. So if this scenario happens where the stock price stays below, GameStop just sends the money back, and they will have gotten to benefit from all the interest that they generated with that cash, the Bitcoin they bought with that cash. They get to keep the benefit of that, and they don't owe any of it to the convertible bond lenders. Now, what if the stock is barely above 29.85? So even if it's just barely above, the convertible bond holders will convert. But it's GameStop's choice whether to pay back with dilution or cash. And I'd say that it the closer that the share price is to these strike prices, the more likely that GameStop would say, "Hey, we're going to pay you back in cash and we're not actually going to dilute." I would say dilution is priced into the stock right now. And so if they chose to dilute, or sorry, if they chose to pay back in cash instead of diluting, if all the buyers for these convertible bond holders are ARB desks and bond funds, then basically GameStop's stock price would increase proportionally to the amount of dilution that was already being priced in. But if the buyers for these convertible bond holders are short sellers, GameStop paying back in cash instead of dilution could certainly trigger a short squeeze if all of a sudden short sellers lose all of these locates and all of these shares that they were selling against, right? But again, either way, GameStop still gets to benefit from the cash. So there's no like in any scenario where the stock price is above the conversion price, there's no inherent risk to GameStop other than the dilution, which is already being priced in. Any scenario where the strike price of the price of GameStop is below the strike price, the only risk is will they be able to pay it back? And as long as they're keeping this money in the bank, then yes, obviously they will be able to pay it back. But let's talk about what if the price is way above the conversion prices. Again, they will be converted, right? And what's the risk to GameStop? The risk is pretty much that like in hindsight, GameStop may have preferred to raise money a different way, right? Like they might have just wished that they had standard bonds and paid some interest because they're paying however much GameStop's above the conversion price. Basically, that's the more money that they're paying for this debt. And so you could say, like, man, if they're at $100 a share, is it possible that GameStop says, man, we should have just issued bonds? Like it's possible, but that's all hindsight. It doesn't put a risk to the company. It's just like, oh, that ended up being expensive debt. But it's also possible GameStop would say, yeah, and it was worth the premium we paid for that debt for it to also be basically risk-free, interest-free debt. And so but still, it's possible that GameStop would say, man, we kind of regret that. Of course, they would never say that. Um, but also, if GameStop said $100 a share in April 2030, which it probably, there's a good chance that it's above that. It's also very likely GameStop would have already been able to raise even more capital with even greater terms for their interest. Right. Similar to MSTR, like once the ball gets rolling, once the stock price and market value of GameStop continues to appreciate, once more and more businesses are being acquired and there's more ability for investors to project the future value of GameStop's ability to raise even more money is going to increase. And as long as their business goal, right, is to utilize money to maximize value, like I'm going to be able to use this money to make more money for my shareholders than the cost of this money. As long as GameStop says that's their business priority, then again, the dilution won't necessarily even be a huge deal to them. The underlying price that they basically paid for these early convertibles won't be a big deal to them because essentially the early convertibles became the catalyst for GameStop scaling. Now, what if the GameStop is imminently above the early conversion prices? Will the lenders convert early? Well, a couple reminders. One, there's two types of lenders, and maybe three if you include short sellers. And neither of them are interested in holding equities long term, including short sellers. None of the three of them are long term interested in holding equities. So a conversion of the bonds is basically them exiting their position. And you got to think about why would they want to exit their position? The other thing you want to think about is they can sell these bonds to like between one another, between institutional clients. So as long as there's a type of buyer for these bonds, if you wanted to exit your position, you'd probably just sell the bond at the current value to the other institutional client that wants to buy the bond rather than converting the bond and then selling the underlying equity that you received through its conversion or realizing all the gains of the cash that gets paid to you from GameStop. So the bond funds, they would probably lose interest in holding the convertibles if they felt GameStop no longer had meaningful upside within the term of the bond. So basically, if they short squeeze, like if their value is way beyond what their fundamentals can support, like if GameStop is worth $1 trillion per share right now, like bond funds would probably not want to hold these convertibles, right? They'd probably seek to exit. ARB funds would lose interest if they felt that GameStop no longer had meaningful volatility or the options on the market no longer commanded a premium. But if GameStop appreciates well above these prices, which that's what has to happen for lenders to be allowed to convert early, right? And if GameStop is 40% higher than it is right now, well, the odds are that volatility would increase and that there would be even more profit to be made from delta hedging and exposure to that gamma. If they short squeeze, you would think that would be even more true, that ARB funds would have even more of a reason to hold these convertibles, even more money that they could make. Generally speaking, just any company, period, any convertible bonds, usually they are not redeemed early. Usually, if they're redeemed early, it's at the company's discretion because the company got even better terms later down the road. It's not usually at the lender's choice to redeem early. And GameStop is not allowed to redeem early until 2029 and 2028. That said, if GameStop squeezes and then comes back to a price that's way above the early conversion price, so they are worth $1 million a share, but then they're worth $200 a share, and simultaneously IV is crushed, there's no volatility left, and there's still a long time until the expiry of the terms, then I think that ARB funds would lose interest in that scenario and that convertibles would redeem early. Now, the short sellers, like would they want to redeem early? I think is an interesting question because, and I think I get into it in this last point, like what if, so okay, bond funds and ARB funds probably don't want to convert early, but what if they do? Like what happens? Well, it's GameStop's choice, again, whether to pay back in shares or not. Um, so there's no inherent risk to the company. Like nothing bad happens, right? It's just all that happens is this money that you've already been paid stays in the bank, and this money that's currently being listed as a liability comes off the books, right? So your true book value goes up by the 4.2 billion that goes out. So I would say that the earlier that the bonds convert, though, the more likely that GameStop would pay them back in shares rather than cash. And that the higher the conversion price, the more likely that GameStop would pay them back in shares rather than in cash. I think if, next week GameStop's at $1,000 per share, like there's no way GameStop's paying the cash value of those 33 point whatever shares that they were that they need to pay back, right? So the sooner that they're converted, the less likely that GameStop has the realistic option to pay back in cash, which I don't think it's GameStop's goal to pay these back in cash, by the way, but it pretty much guarantees like, okay, dilution is going to happen. I would say the sooner that dilution happens, is that helpful for shorts? I think maybe, like right now but it might not be necessarily, strictly speaking, helpful for shorts for the dilution to happen right away if they're able to use like if they're able to use the locates, the presumed 1 day dilution, the same way that they're able to use an actual share, then in that sense, the shares officially being diluted probably wouldn't have an impact. But if short sellers are not really able to benefit from the convertible bond, but they are able to manipulate the actual shares in existence, then yeah, the sooner that dilution happens, the sooner shorts could potentially use them to cover, roll positions, open new shorts, manipulate the stock, etc. Is that inherently risky to GameStop? Not at current valuations, because again, at current valuations, they're not being respected as a company. So shorts are already having their way with the stock, and their ability to short the stock below its cash value is negligible. I do think, though, this threat of early conversion from short sellers is part of the reason why GameStop issued these warrants. Because GameStop's saying, hey, even if you dilute early, that means that our stock price is above these thresholds, which means it's well above $32 a share, which means we are going to raise 1.9 billion in more cash from those warrants getting exercised. So that 1.9 puts them at 11.1, which is exactly what they were trading at when they issued those warrants, right? And right now at $26 a share, they're at 11.6 market cap. So does an immediate conversion help short sellers? Well, maybe it gives them more shares to mess around with, but what can they even do with more shares if it also gives GameStop 2 billion more in the bank, which brings GameStop's floor price right up to its cash price, its net cash, which it really would be truly net cash at that point because these debts would be off the books, right? It would be 9.4 in book value plus the 1.9 plus whatever they generate in free cash flow during Q3. It brings them right up to their market cap. So right now, you don't really need to fear, what if short sellers get stronger in their ability to short? I mean, as Ryan Cohen said in his interview, let them short, right? But if GameStop was trading at $100 a share, $200 a share, which wouldn't be crazy, but it would imply that they're being valued at a decent multiple, then you would think that, yeah, maybe the early conversion somehow elongates the journey for the GameStop holder who wants to burn the shorts, etc. Like, but again, so the last thing I would say with that is, again, it in this scenario, it's also very likely that GameStop has an even greater ability to raise even more funds at even more favorable terms than before. Because again, the ARB desk demand for these funds would be much higher, right? And if these early conversions are, if these are coming off the books, then that means there's no more convertibles left, right? So anyone that has any interest in GameStop convertibles, they could raise another blank $1 billion and it would represent an even smaller percentage of their market cap than right now. The 4.2 billion in convertibles is is what, like 35, 38% of their market cap, right? So if those come off the book for early, it's very likely that GameStop has more funds. Um, and also the sooner it happens, like if it happens quickly, right? If they convert early in 2027, it's like, look, we got there's a lot of time for a lot of great fundamental performance between now and then, right? But if they convert early next week, it means that GameStop just blew up. And if GameStop's blowing up, well, now there's global attention again, there's momentum from retail investors. The threat of a short squeeze would probably increase, like the hype going into the stock would probably outpace the 32% dilution that shorts could potentially leverage, right? So if it converts super early, there's probably more bullish momentum outweighing any dilution effect. If it converts modestly early, there's so much fundamental growth supporting GameStop's ability to raise even better, more funds at better terms that kind of overshadows the impact of that dilution or minimizes the impact of that dilution. And if they don't convert early, then that's probably just as well or maybe even ideal from GameStop's perspective. But likely that if GameStop continues to execute how they want to, that they will be the ones to redeem these funds early, having already raised new funds or bigger funds with even better terms, longer terms, etc. So that is the 411 on the convertible bonds. Let me know if there's anything I didn't cover. Any other questions? I wanted to go granular again because my business, and I wanted you guys to know this through and through and understand like what are the risks. It's not necessarily an infinite money glitch as it's talked about before, but with GameStop, the way that they priced these, it was frustrating as a shareholder to see the pricing date coincide with the stock getting slammed 25% or whatever, right? Like these conversion prices are so low, which as a bull was frustrating. But as a bull who wants to protect his downside, this is super clutch because it essentially guarantees the ability for GameStop to choose this to be dilutive and allows you to truly treat this balance sheet as if the debt is not there, unless something like literally like civil war type just craziness. But even then, again, the cash, just the cash generating cash is going to put you on pace to exceed these conversion prices, which if these conversion prices were 38, then you would have to say, well, in all likelihood, it's going to be above 38, but there's a chance that it's not because what if the growth just halts, you know? But at these conversion prices, it's like the growth could halt. The growth could go totally AWOL, and they're still going to justify, they're going to have a cash value on the books that exceeds these conversion prices. And so that's exciting for GameStop, particularly with the percentage of their book, the percentage of their assets that are represented by this 4.2 is pretty high right now. And so I think knowing that they will be able to write off that debt and basically make it poof go away through dilution, I think it's nice as a shareholder to know that you will have that option. It will be GameStop's choice if they dilute, and they could, surprise, surprise, if their stock is still not being respected, they could just pay it back in cash and say, boom, no shares for you, which I think would be a pretty fun rally. So whether it happens sooner or it happens later, I think the convertibles definitely set GameStop up for a lot of upside and a lot of different ways that they can play it to their advantage. Anyways, that's all I got for y'all on this one. I will see you guys soon. Oh man, I pressed stop sharing instead of stop recording. So now I don't have the epic. I don't have the epic outro. Hey, if you're here for the outro, um, all I want to say is that's my bookshelf, and just 2 weeks out, maybe even 1 week at this point, until my daughter's born. First girl, third kid. All right. Thanks y'all for being here. See you later.